$200 billion, that's the exact amount of cash that just hit the mortgage market. And it didn't just lower rates, it cracked open a window that I think closes in about 60 days. This is the government signaling that they will not let asset prices fall. They are essentially printing money to keep those asset prices high, which means your savings account is basically a burning building right now. Let me walk you through what's going on. President Trump just pulled a massive lever. He ordered Fannie and Freddie to spend $200 billion. That is a serious chunk of cash coming right out of their cash reserves. And what was that cash for? What's the mission? Buy mortgage bonds and force interest rates down. And look, it actually worked. Rates dropped about 20 basis points basically overnight. And here's what stands out most. The number you need to wrap your head around is the $200 billion. That is a lot of liquidity just getting dumped into the market. It's basically printing money, but without the Federal Reserve involved. We saw the 30-year fixed rate dip from the low sixes into the high fives. But there is a catch here. That money, it came from the safety fund meant to protect taxpayers if the whole thing crashes. The easiest way to picture this is, think of a high-rise condo board that has saved up a massive reserve fund to replace the roof when it eventually rots. The board president walks in and says, hey, nobody likes paying these high monthly dues. Take the roof money and use it to pay everybody's dues for us right now. Suddenly, living in this building is cheap and everyone is happy. But if a storm hits tomorrow and the roof caves in, the bank account is empty and there's no money left to fix it. But here's what shifts because of it. If you bought a house late last year and your rate is sitting at 7% or higher, you do have a window here. You might be able to refinance and save some actual cash every month. And for home builders, this is a huge relief. They don't have to eat into their own profits to buy down rates for you anymore. Uncle Sam is basically doing it for them. Here's why this hits home for people. If you're trying to buy right now, that sounds like a win. But you know how this goes. Lower rates bring more buyers out of the woodwork, and that means more competition. So while your interest rate might be lower, the home prices get bid up. Whatever you save on the monthly payment might get wiped out by the higher price tag. And here's the part most folks never hear about. The White House thinks the Fed is moving slower than molasses. The president can't legally force the Fed to cut rates, but he can order the housing agencies to empty their savings account. And that sends a pretty loud signal. If the central bank won't print the money, the administration will find it somewhere else. Now, here's how different experts see it. Some folks argue this is just using the government's muscle to fix affordability. They say we had to do something to unfreeze the market. But the analysts I trust are warning that this is temporary. They're saying $200 billion is a drop in the bucket, and it won't keep our rates down forever. And economists are worried that this is just Band-Aid on a bullet wound because it pumps up demand without actually building any new houses. So here's the angle nobody else is tracking yet. We're seeing a shift in how the government uses its balance sheet. It's moving from a safety net to a political tool. It creates a sugar high in the economy. We're juicing the market with lower rates, but we aren't doing the hard work of fixing the supply problem. And yes, there are two totally valid interpretations here. On the one side, the gap between treasury bonds and mortgage rates was huge. You could argue the government had to step in and fix that. On the other side, dumping cash into a market with no inventory, it's inflationary. Critics say we're stripping the safety gear off the mortgage giants right now when things are shaky. And if you zoom out, the big players are thinking this way. The smart money sees this as a rule change. The executive branch realized it has a pocket of cash it can control, and they aren't going to give that power back. Future administrations are going to look at those reserves as political capital that they can spend. And here are the questions everybody's asking right now. Will it rates hit 4% again? So I wouldn't bet the farm on it. High fives is probably the floor. Should you lock your rate in now? Yeah. Like yesterday, the market moves fast. Does this mean home prices will drop? Possibly the opposite. Cheaper money fuels bidding wars. Is taxpayer money at risk? Technically, yes. If the housing market crashes, the buffer is gone. But before we can predict anything though, here's what we still need to know. We need to know if the rate drop is actually worth the brain damage of refinancing. We need to know if this cash injection makes the Fed mad enough to delay their own cuts. And we need to see if the bond market fights back. If you have a read on any of that, drop it in the comments. I do read them. So has anything like this happened before? Yep. And here's how it played out last time. Back in 2008, Fannie and Freddie failed because they were broke. We spent the last 15 years saving up that capital to make sure it never happened again. This move undoes a decade of discipline in 1 week. It's prioritizing a quick win over long-term safety. So here's the quick version for the wealth preserver focused on protecting capital. Look past the headline about lower rates. This is the government injecting cash to prop up prices. It feels good now, but it signals inflation down the road. So if you're sitting on cash waiting for a crash, you got to realize the system is rigged to stop prices from falling. They are using the dollar to prop up asset prices. This just proves you need to own real, tangible assets, not paper money. But for most, the barrier isn't the capital. It's the headache of finding the deals and managing the renovation. You want the tax benefits and the hedge without taking on a second job. This is exactly why I pulled out a breakdown on real estate automation, which you can watch next. It shows you how to bypass the grunt work and go straight to holding the deed. You get to see how the numbers work when you remove the operational drag. And you'll understand why owning the asset directly is the only real shield against what's coming.